All right, let's talk HCA Healthcare. They just dropped a monster third-quarter earnings report that on paper should have sent the stock soaring, but it didn't. It kind of fizzled. So what's really going on here? Let's break it down.
Okay, first, let's look at the headline number. HCA posted earnings per share of $6.96. Now, that's not just a beat. That's a 22% beat, an absolute demolition of what analysts were expecting. When you see a number like that, you really have to sit up and pay attention.
And it wasn't just on the bottom line. The top line was just as impressive. Revenue came in at $19.16 billion. That's more than $600 million higher than expected. So you've got this massive beat on both revenue and earnings. It's the perfect setup for a victory lap, right? Well, mostly.
As you know, those headline numbers only tell part of the story. The real question is always why. What was actually driving this incredible performance? So let's decode these results and unpack the key drivers.
So yeah, what was behind the beat? Was this just some sort of one-time fluke, or is the core business fundamentally just that strong right now? The underlying numbers, well, they tell a pretty clear story. Just take a look at these same facility metrics. You're seeing solid growth pretty much everywhere. Admissions are up over 2%. ER visits are up. But the real kicker, the number that really jumps off the page, is that revenue per admission. It's up a whopping 6.6%. So it's not just that more people are coming in the door, HCA is generating a lot more revenue from every single one of them. That's a powerful combination.
And this slide really shows you how they did it. It starts with a fantastic payer mix. Their most profitable segment, that's commercial and exchange patients, grew by a massive 8%. You add to that really strong Medicare volumes and high demand for profitable surgeries like neuro and cardiac, and you've got a recipe for success. And on top of all that, they ran a really tight ship, managing expenses to improve their margins. It's the perfect storm of positive factors.
So with everything going so well, you'd expect management to feel pretty good about the future. And they do, but they also threw a big wrench in the works. A policy risk that's creating this real push and pull for anyone looking at the stock. First, the good news. Management didn't just nudge their guidance up, they raised it substantially. The new revenue range is well above the old midpoint, and they boosted the EPS guidance by more than $1.50. I mean, that signals some serious confidence that this momentum is going to carry right through the end of the year.
But, and this is a huge but, here's the bombshell. Right on the earnings call, the CEO, Sam Hazen, came out and said this about the ACA premium tax credits. He admitted, "We still do not know how this policy will play out." And that's a huge deal. This policy affects millions of their patients' ability to afford insurance. And his comment just cast this big, dark cloud over what should have been a purely celebratory moment.
So what happens when you mix a fantastic report with a giant looming question mark? Well, let's look at the market's mixed reaction. The stock's journey on earnings day really tells the whole story. It's a classic pop and fade. It's actually fascinating to watch. In the pre-market, based on those headline numbers, the stock was flying, indicated up almost 5%. It opened strong, even rallies a bit higher. But then, as the conference call went on and investors started to really digest those comments from the CEO, all that early enthusiasm just evaporated. The stock bled gains all day and ended up closing with just a tiny 1.6% gain. The market was screaming, "We love the quarter, but we refuse to pay up for the future until this ACA risk is gone." So where does that leave us? Let's get to the next call, our take on what's next for HCA, including our outlook and our rating. Okay, here's our analysis from Talk Tickers, broken down into 3 parts. First, the Q4 outlook. We expect another fantastic quarter. The business is absolutely humming, and they're also going to get about a $100 million tailwind to EBITDA as they lap the impacts from last year's hurricane season. Second, the price action. In spite of that operational strength, we think the stock is stuck in neutral. It's going to be range-bound until there is definitive clarity out of Washington on those ACA subsidies. Big money just won't commit with that kind of overhang. And third, our rating. We are rating HCA as outperform. The company's execution is just exceptional. It's best in class. The risk here isn't operational, it's a binary political outcome, and we're willing to bet on the fundamental strength of the business.
This is not financial advice.